It's early, your coffee is brewing, and the official stock market hasn't even opened yet. You check your phone and see the news buzzing about what the futures did overnight. The screen is flashing bright green or deep red, and your heart rate starts to climb. The big question is, should you be worried or should you be celebrating? Are these overnight numbers actually predicting your portfolio's performance, or are you just looking at early morning noise?
Just a note that this video is for educational purposes and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
To understand the futures market, we first have to compare it to the equity market, the Goliath, where you buy and sell actual shares of companies like Apple or Nvidia. The equity market is a giant. We're talking about 17 billion shares changing hands every single day, with a total value of about $1 trillion. The futures market, however, is the David of the story. It is much smaller, trading only about 7 million contracts a day, with a cash value of around $100 billion. So, if it's so much smaller, why does everyone talk about it? The secret is leverage. In futures, traders can control a huge amount of stock with a very small deposit, usually 10 to 20 times the money they actually put down.
Have you noticed that the stock market almost always opens at the exact price the overnight futures were trading at just moments before? It's not because the futures market is a psychic, it's because it's actually setting the opening price. Think of it this way. The futures market stays awake all night while the stock market sleeps, reacting to news from Europe and Asia. When the New York Stock Exchange finally wakes up, it has to play catch up to the price levels futures traders have already established. At the opening bell, futures are 99% accurate at telling you where the day will start. But here's the catch. Once the big Goliath market wakes up, the predictive power of futures starts to fade fast. Statistically, futures are only about 55% to 60% accurate at predicting where the market will close at 4 p.m. That's only slightly better than a coin flip. The reality check is that a single economic report at 8:30 a.m., like inflation or jobs data, can instantly wipe out 12 hours of overnight prediction in a heartbeat.
So, when are futures actually useful? Only in the very short term. Generally, the futures market acts like a scout, leading the actual stock market by about 1 to 5 minutes. In today's world of AI and high-speed computers, that lead has likely shrunk to seconds or even milliseconds. The rule of thumb is, if you want to know what the market will do in the next 10 minutes, look at the futures. If you want to know about the next 10 hours or 10 days, don't bother.
The most important takeaway for long-term investors is this. Futures traders don't move the markets in the long run. Futures traders are often speculators, guessing what the real owners of the market are going to do. The people who actually move prices are the main body of shareholders, the pension funds, and institutional investors who own the companies. Futures traders might cause a little splash in the morning, but they don't change the tide.
Thanks for hanging with us. Now, I want to bring in Pete, our peer reviewer, to play devil's advocate and highlight a few things the data might miss. Pete, what's the other side of the future story?
Thanks. Look, I love the stats, but I have a few caveats for anyone trying to master this. First, we have to talk about the AI elephant in the room. We are seeing a massive technological shift right now, and the reality is that the past doesn't always predict the future, especially when algorithms are doing the trading. Also, we've mostly talked about equity index futures today, but there is a whole world of other futures markets, like oil, gold, or corn, where people are betting real money on real-world supply and demand. Sometimes those specific markets are incredibly spot on, so don't write off all prediction markets just because stock futures have their limits. And let's not overlook the Asian and European markets. They're busy trading while Wall Street is asleep. Their combined daily trading volume nearly rivals that of the US equity markets. Finally, everything we just discussed applies to normal market conditions. When there's a major crisis or a global event, all standard predictions can go right out the window. In moments of pure market panic, futures can end up being either perfectly right or dangerously wrong. There is no middle ground in a crisis. Back to you, John.
Thanks, Pete. And thank you for listening. We've covered a lot of ground today, but this is only one of 30 critical topics in our video series and in our comprehensive guide available on Amazon Books and Kindle. The link is in the description, and I'll see you in the next videos, which are about market crashes and oil prices. See you then.